Hello, my name is Kinga Winiarska. I'm a president of Western Michigan PMI. Today we have a virtual lunch meeting, and we are going to be talking about financial stability in a time of chaos. The speaker for today's presentation is Jonathan Luibrand, and the moderator is Karen Streitel. Jonathan has been with Primerica for a little over a year and provided free advice to many Grand Rapids residents on PFS Investments and how to manage finances. His previous experience includes running financial analysis, business lending, audit, and compliance. Karen has 10 years experience and has helped people earn more income, become properly protected, debt-free, and financial independent. Please help me welcome Jonathan Luibrand and Karen Streitel.
Hello, and thank you so much for having us. Today we will cover financial stability in a time of chaos, and specifically why now is always a good time to invest. I will ask a few questions throughout the presentation, and if you could enter those in the chat box, that would be great. If you would like to contact the presenters, our contact information will be on the last slide. So let me start by saying that for long-term investors, we believe now is always a good time to invest, even in down markets. Investing is one way you can help build wealth. We teach people the fundamentals of investing, a few of which we'll cover today that work particularly well in this market. Let me explain two terms that you will hear often today. Bear market, which is defined as a decline of at least 20% from recent 52-week highs, and bull market, which is defined as an increase of at least 20% from recent 52-week lows. Think of a bull thrusting its horns up in the air when attacking its opponents, while a bear will swipe down, bull up and bear down. Before I get started, let me tell you a little bit about who we are in order to lend some credibility to what we will discuss today. We are the largest independent financial services marketing company in North America. We have over 130,000 licensed representatives. We're listed on the New York Stock Exchange, and our ticker symbol is PRI. We've been in business for 43 years. We insure over 5 million lives, and we have over 2 million investment clients. And in 2015, we were named one of America's 50 most trustworthy financial companies by Forbes, and we have over $61 billion in assets under management. So let me just give you a brief overview of what we'll be covering in today's presentation. We will take a look at market cycles and historical perspectives. We'll cover proven investment fundamentals, and then we'll take a look at some investment solutions. Let's get started with some perspectives on investing. Sir John Templeton, who was a legendary investor and mutual fund pioneer, he created the Templeton Funds. He was an Oxford University Rhodes Scholar, and in 1999, Money Magazine called him, quote, arguably the greatest global stock picker of the century. He made a timeless quote regarding investor emotion and how that affects and is affected by the market. He said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Again, Sir John Templeton is talking about investor emotion and how that affects and is affected by the market. Let's take a look at how they relate. This is called the cycle of market emotions. It shows when the market is moving up, people feel really good about investing. And then on the way down, those feelings tend to change. So a chat question for you today, who's thrilled or euphoric about the market right now? Who has some fear? Anyone out there panicked? Okay, now who's a little skeptical or pessimistic? we tend to see that most of the hands go up with pessimism and skepticism right now. We happen to think that's probably about where we are currently in the market cycle as well. Somewhere down at the point of maximum financial opportunity. So if we're pretty much in agreement in where we're at on the chart, let's recall what Sir John Templeton said about that as it relates to the market cycle. He said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. That's his observation based on many successful years of investing. If that is true, it is possible we are nearing the point of maximum financial opportunity. But many people will miss it. And typically when people move through the down cycle, going through fear, desperation, panic, capitulation, pessimism, they tend to run for safety. Let's look at what happened the last time we went through a down market. So a chat question for you. If you could put a yes in the chat box, if you like to buy things on sale. Anybody like to visit the clearance rack? So Shelby Cullum Davis, who was a legendary Wall Street investor and a leading financial advisor to governors and U.S. presidents, he was also a U.S. ambassador to Switzerland. And he said, you make most of your money in a bear market. You just don't realize it at the time. That one bears repeating. You make most of your money in a bear market. You just don't realize it at the time. Shelby Cullum Davis, the legendary Wall Street investor we are quoting here, turned $100,000 in the late 1940s to $900 million by the 1990s through careful and sensible investment practices. You can draw your own conclusion about what he attributed a lot of that growth to. Investing during bear markets when people are pessimistic and skeptical isn't always the easiest thing to do. However, the values created in bear markets have historically been great opportunities to make significant gains. A probable point of maximum financial opportunity. Though there are no guarantees in regards to the market, but historically we have seen significant gains from off the bottom of a bear market. Now, I don't know when the bear market will be or if we are already there. Usually we can't pinpoint it until we're well past it. But if you aren't trying to time it, you won't miss it, right? Let's look at some history. This slide says, history is a great teacher. Let's look at some historical returns coming off the market lows following significant market downturns. Let's specifically take a look at the financial crisis from October 07 to March 2009, where there was a 57% decrease in the market. And you can see that 1 year following that decrease, in March 2009, you would have experienced a 49% return and a 5-year return of 161%, which equates to about a 21% annualized return over those 5 years following the March 2009 financial crisis. Something else I'd like to mention. If you were exposed to the equities market from 1930 until today, you would have a 15,000% return. And if you miss just the top 10 performing days from each decade over that same period, your return would be 91%. That's a great example why not to try and time the market. Now, we always need to keep in mind that past performance is no guarantee of future results, and no one can consistently time the market with accuracy. But what one can do is study the past and heed from wisdom of successful investors for guidance. I think that's a pretty good idea. When Shelby said, "You make most of your money in a bear market, you just don't realize it at the time," I think he said it from experience. Here we see that it's time, not timing, that matters. If you made one $10,000 investment each year in the S&P 500, immediately following the market high or market low, for 20 years, this illustration shows that regardless if you invested at the highs or the lows over each of the last 20 years, you would have experienced gains of either 9% or 10.45%. The amazing thing is that the average investor earned just 2.6% over this same time frame. Why is this? Maybe it's because they were throwing darts, they didn't have an advisor, maybe they were investing with emotions, fear, uncertainty, or they were never taught how money works. So chat question for you. Has anyone heard of the Rule of 72? If so, if you could put yes in the chat box, that would be great. We will review the Rule of 72 now, and I'm sure that it'll show the importance and significance of a small return difference, such as 1.45%. So let's say your grandparents gave you a high school graduation gift when you turned 18, and that $10,000 gift earned an interest of 3%. What you could do is you could take 72, the rule of 72, divide that by the interest rate of 3%, and that would give you 24 years. So that's how long it would take for your money to double. If you earned 6%, you would take 72, divide it by 6, and that would equal 12 years. So your money would double in 12 years. So you start out with 10,000. After 12 years, you would have 20,000. After 36, you'd have 80,000. And then after 40 years, you would have, for 48 years, you'd have 160,000. If you took that same $10,000 and invested it at 12%, let's take 72 divided by 12, that gives you 6 years for your money to double. So the first year you'd have your $10,000, and by year 48 you would have $2.56 million. So let me ask you, how do you win at a game if you don't know the rules? Do you think banks or insurance companies have any incentive to teach us this rule? I don't think so. Would you benefit for learning this rule? And shouldn't we have all learned this in school? This row here shows how important it is to maximize your investment earnings, and that compounding interest separates the rich from the broke. The great Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." So using history and insight as a guide, I think we've made a good argument for not sitting it out. Now let's talk about some core investment concepts that will help you become a successful investor. There are 3 basic and proven investment fundamentals. We refer to them as the 3 Ds: dollar cost averaging, discipline, and diversification. Dollar cost averaging is investing a certain fixed amount each month, regardless of what's happening in the stock market. Discipline is staying focused and invested through all market activity. And diversification is building your portfolio by balancing a variety of investments. Let's start with some perspective. The quote here says, "Bad news is an investor's best friend. It lets you buy a slice of American future at a marked down price." Warren Buffett is another legendary investor. A lot of people have heard of him, but I'll tell you a little bit more about him in a minute. First, let's talk about the quote. What is he talking about? You mean that bad news can actually be a good thing? Well, for smart investors, it may be. What happens when we go through an economic downturn and volatile times is that people become fearful and panic and then capitulate. When they capitulate, they sell, just like we saw in the cycle of market emotions. A lot of times when the market goes down, people sell indiscriminately, helping to drag the price of otherwise sound company stocks down. I know that's true, but I also know that I'm not a stock picker. I leave that up to professional money managers. They have the expertise and experience and resources to research companies and find these sound investments, but sound but undervalued stocks for their mutual funds and portfolios. Here we'll take a look at systematic investing, which is a proven method allows you to use dollar cost averaging to build wealth over the long term. So, chat question for you. Would you rather be investor A or investor B? So if you're an investor, you're putting $100 a month into your investment program. Which one would you rather be? Investor A in the rising market or investor B in the fluctuating market? Investor A and B both invested $100 every month into the market, but investor A only accumulated 42 shares in the rising market because the price per share was climbing. Investor A is a $100 investment, could buy more shares in the first few months, but that same $100 didn't go as far in the last few months of the graph. Meanwhile, investor B was able to take advantage of a fluctuating market. When the price per share declined, investor B's $100 monthly investment could buy more shares as the prices fell. Over time, investor B was able to accumulate 3 times as many shares as investor A and get in position for those shares to appreciate in value at the next market gain. The key is to put your savings program in place and keep it up every month, regardless of how the market is performing. By investing the same dollar amount of money monthly or quarterly, regardless of what the market is doing, you have the potential to lower your average cost per share. And in this example, we see that investor A accumulated 42 shares at $20 per share for a value of $840. And investor B has accumulated 126 shares at a value of $10 per share for a total value of $1,260. So quite a significant difference between those two investors. Let's bring Warren back into it. This is what he said back in October of 2008. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. Based on past experience, we typically see the market begin its move back upwards, even if the press is still talking gloom and doom, many times before all the economic indicators are positive as well. The market tends to be a leading indicator of the economy. That usually happens when many people are still holding cash and waiting for the good news, so they miss out on that early movement, which could be substantial. This slide says, invest with your head, not with the headlines. It seems like every time we pick up a newspaper or turn on the television, we can find another reason why today is not a good day to start investing. And over the years, there have been plenty of reasons not to invest. However, for the long-term investors, the results have generally been positive over time. But in spite of all the bad news we're exposed to every day, if 10,000 were invested in the stock market, as represented by the S&P 500 on December 31st of 1988, and held firm through all of the scandals, financial crisis, conflicts, and other bad news over 30 years, the investment would grow to almost $210,000, which is an annual rate of return of about 10.69%. Let's continue with invest with your head, not with the headlines. This chart shows the value of that original $10,000 investment each year. It shows the annual return for the year, and it shows a headline, one that may have caused an investor some concern. Let me ask you, how many negative returns do you count? They are the ones in red. In the last 30 years, investors have experienced just 5 years of negative returns. Over 80% of the time, the market has had a positive return for the year. But wouldn't the headlines make you believe that there were more bad years? The most important thing to remember is that historically, every major setback the stock market has suffered over the past 30 years has been temporary. Of course, past performance does not guarantee future results. Nevertheless, the market has typically recovered, as the charts indicate. So do you see how over time you can achieve your investing goals regardless of the headlines? How many of you, chat question for you, how many of you are afraid of what the market is doing to your money? Here's an example of a chart where we really need to stay focused and invested through all market activity. You can utilize dollar cost averaging and take advantage of a fluctuating environment and clearance sales. Typically, we have a market correction every 3 to 5 years, so it should be expected and not feared. In the last 2 months, the S&P 500, which is a collection of the 500 largest U.S. companies, was down 34% and then up 23%. So a question for you, if you could put in the chat box, is this presentation easing your fear a little bit? The third D I want to talk about is diversification. Diversification is a time-tested principle. We use this chart to show how the various market asset classes performed over time. One of the most important strategies for achieving your long-term investing goals is diversification, spreading investment dollars across different types of funds based on your goals, needs, and risk tolerance. This strategy may help reduce risk, and it can work to increase returns by offsetting losses in one asset class with an increased opportunity for gain in another. This chart helps to illustrate how the returns of different asset classes have varied from one year to the next. It helps to demonstrate the challenges with trying to predict the next top performing asset class. Given the volatility in the market, no one can know, and I mean no one can know for sure, which asset class will be next year's top performer. However, a properly diversified portfolio can help to reduce downside risk and increase upside potential for the long-term investor. I should point out that diversification does not guarantee against a loss or ensure a profit, but diversification may help spread out the risk in your portfolio. We believe it's a good idea to be diversified, and you can do that with various stock and bond asset classes. You might be asking yourself now, how do I do that? What is the right mix? Over the next few slides, Karen will talk about just that.
Hey, great. Thanks, Jonathan. Didn't Jonathan do a great job explaining how our money works, how the market works, and how we can make this volatility work for you to put you in a better position over the long haul of your financial goals. So my name is Karen Streitel, and I've been with Primerica for 10 years now. And what I absolutely love to do is teach people how their money works, how to get in a better position, how to put your plans together, project management, if you will, of people's finances. And I especially love the investment side of this business because I've seen where we could take somebody who didn't think they could retire, put a plan together, and make that dream happen. And that is just so incredibly rewarding. So what I am looking to do today is to show you how to take the information Jonathan gave you and how we're going to apply it to yourself with managed risk. If we can manage the risk, you would have a better outcome. So that's kind of what I am going to look to do today, is how to manage that risk. There's several different things that we need to look at. One of them is to take a step further on this diversification of what Jonathan was talking about. One of the longest investment vehicles that have been around are something called a mutual fund. Now, I bet everybody here has mutual funds in your 401ks or your IRAs, but we don't really understand what they are. So I'm going to attempt to give you a couple different explanations to see if we can clear some of that up. So a mutual fund is managed by a professional money manager or a group of professional money managers. And what they do, because they're experts with the finances, with the vehicles that we use to invest with, such as bonds, securities, stocks, all of those different financial vehicles, commodities, that type of thing. They're experts with what things work best together. So what these professional money managers do is they bundle a bunch of these up, could be up to 150 of these things. No matter what they are, they're probably a good cross-reference of a lot of these. And they bundle up together and they give them a name and they call them mutual funds. Now there's 8,000 plus mutual funds on the market today. That is a lot of choices to pick from. So you're probably saying, holy cow, how am I going to figure this out? Well, you might want to go to somebody who's licensed in this field to help you pick those out, who will sit down and listen to your preferences, your goals, where you want to go, and where you're coming from, and how to get there. So, bottom line is, you can either research it and get yourself knowledgeable about it, or you can go to somebody who's licensed and can help you. But what it is, these mutual funds are bundled, and we put those, a bunch of investors, you and I, probably if you work for a corporation, everybody in your company belongs to the same 401k. We're all contributing money, and we're all picking which mutual funds we want the money managers to put our money towards. So that's kind of how it works. So it's a bunch of investors who have pooled their money together. It's some money managers, and it's all of these little bundles, 8,000 little bundles to pick from. Now they're categorized, so you could have a preference for some growth funds if you are in the accumulation phase. If you're nearing retirement, you maybe want to switch those to income or stable funds. Some people like the specialty funds, such as tech stocks or tech funds, pharmaceutical funds. There's consumer funds. There's all kinds of funds out there, and it just depends on your preference and your goals. So I'm going to ask you all to draw a little diagram for me, because a picture says, a picture is 1,000 words. And sometimes this might make more sense to some people. I know it made a whole lot more sense to me. I totally understood it after this diagram I'm going to show you. So what I want you to all do is pull out a sheet of paper and put two boxes side by side. And what we're gonna do is we're gonna draw in the first box, you're gonna draw from the top of the box, one line all the way up to the top of the paper. And you're gonna put an S on that box. The second box, we're going to do the same thing, but I want you to draw as many lines as you can from the top of the box to the top of the paper and label this MF. So it's box 1 and box 2. Kind of sounds like Dr. Seuss, but it's nowhere near what Dr. Seuss is. So bear with me. This is my elevator theory. And what I want you to do is picture yourself getting into elevator number 1, the S elevator, and you're heading up to the 20th floor of whatever building, and all of a sudden you hear a noise up above you, and the cable is starting to fray, and your elevator is starting to toss. How are you going to feel? You're gonna probably feel really nervous, really fearful, really scared for your life. Well, what if that cable just flat out broke? You're going to be tumbling down, and depending on how far your elevator is up that ladder, as to how far you're going to drop, will determine how bad the damage is going to be. So let's hop over to elevator MF. Elevator MF is held up by multiple cables, could be up to 150 cables. So let's say I'm on my way up to the 20th floor, and 2 or 3 of those cables just snap. They just, out of the blue, just snap. Am I even going to feel that in that elevator? Probably not, because I have 147 other cables holding me up. Now, the money manager is watching that, and he's going to replace those cables if he feels the need to. But it might just be a temporary thing and doesn't need to replace those cables at all. But my point is, your elevator, you're still safe. Your elevator hasn't dropped or shifted at all. We call this elevator a mutual fund. So that's the difference between a stock and a mutual fund. A stock, you can get there, and you can get there maybe a little faster with one elevator because it's working by itself. But if it drops, it might be devastating. Whereas a mutual fund is diversified and offers some protection because the pieces inside of that mutual fund are offsetting each other. So that's kind of the story of the mutual fund and how it works. Now, when we're looking at our savings, our college funds, our retirement funds, we have to be aware of the risks that are involved in investments. So on this screen, you'll see there's 3 risks. I actually look at 5 risks, and I'm going to explain them to you, and I'm going to explain why and what I'm looking for. So the first one you can see is longevity. Now, modern medicine has extended the average person's lifespan. So when Social Security was founded, there's a reason that they had the payout at age 65, and that is because that was the lifespan of that day and age. Most people only live till 65, maybe sometimes a little older, but not too much so. Well, the average age today is 85 or 86, somewhere in that neighborhood. So modern medicine has extended our life by 20 years. Well, Social Security wasn't planning on that, nor were they planning on the number of baby boomers that were going to arrive after the war. But anyway, those are some things that we have to be aware of, and we have to plan for those long-term retirements. You could be in retirement for 30, maybe 40 years depending on when you retire. So you have to have enough money put away to be able to live off the interest. There's been many, many studies, a Monte Carlo study that is one of them that research that if you live off 4 to 6% of your investment money, your money is still growing at 8, 9, 10%. Your money is still growing while you're using it. That is why your money is going to last throughout your retirement. And you have to be aware of that. The second risk is the market risk. Now, Jonathan did an awesome job explaining the market and the market risks and the diversification, the 3Ds that we have to use when we're in the market. I don't feel a need to go into that very much further because we all know the ups and downs and you saw the charts. But this third, inflation risk, now a lot of people don't think of it. I call it the silent risk. And why is that? Simply because we don't realize the impact that inflation has on our dollar. So the cost of living goes up, I'm sure all of us are aware of this, goes up 2 to 3% every year. In a 20-year time frame, what that means is that the gallon of milk that I bought today at $2.69 is going to cost me over $5.50 in 20 years. Well, our retirement money has that same problem. So what we're living on today, if you're living on $4,000 a month today, in 20 years, you're going to need $8,000 to live the same lifestyle. That's why you have to make sure you take inflation into account into your plan. Now, the other two that are not on here that are very important is number 4 is taxation. Now, the government taxes whatever they want to tax, right? And everybody tries to hide their money from the government and protect it from that taxation. And there's a good reason for that. Because of compound interest, if you don't have to pay taxes on that money, and it can sit there and compound over the next 20, 30, 40 years, then that's going to increase your savings rate. It's going to increase how much you have put away. Compounding interest, Einstein called the eighth wonder of the world, I believe. So that's what we want is our tax money to compound inside our retirement vehicle in a tax-deferred vehicle. And then we just pay the little bit that we pull out per year as we pull it out. The fifth one, it's not very well known. Nobody really thinks about it, but it's the plan. It's the plan and the strategy of how you're going to use your money when you need it. Now, I have seen people who have saved $1 million that the minute they retired, they went out and bought a cottage, they bought a boat to go with a cottage, and then they bought, a brand new truck to pull the boat. And they spent half of their retirement money. So now they have $500,000 to live on for the next 30 or 40 years. And that may or may not work for them. What I suggest is that I don't suggest that you don't get those things. I suggest that you plan for those things, work it into your strategy, and maybe there's a better way to get those things without pulling the money out of your retirement fund. But have that be part of your plan if that's what you want to do. One of the ways that when I sit down with people is I put together a 3-fund approach or a 3-fund strategy, and you see it up here on the screen. Now, we got real techie with the names of these strategies or the columns. One is a living account, one is an intermediate account, and one is a long-term account. Now, wouldn't you say those are pretty techie names? But they are exactly what they say they are. And I'm going to show you how it works. Most people right now are in the accumulation phase. So they're in the intermediate account phase. We don't even look at the living account column until you are actually going into retirement. So the intermediate account is where we're putting all of our money right now. And we're accumulating it, and we're accumulating it as fast as we can at the highest rate of return that we can, because we know that rate of return makes a huge difference. We're looking for those doubling periods in here. Now, as you get a little bit older, maybe 55, 60, in that age frame, we're going to be looking at taking some of that money. Hopefully you have enough accumulated that we can start funding that long-term account. What I use for those is a variable annuity from Bright House Financial. They've customized, which used to be MetLife, but they customized this program for us. that provided guarantees against loss. They provided guarantees for 10 years worth of gains, and they provide a guaranteed living withdrawal amount even if my account runs out. So in essence, if I fund my long-term account properly, I have just created my own pension. Because I don't know about you, but pensions have been going away, and my company just paid out pensions a year or two ago. They froze them 10 years ago, and they finally just gave us some money. But you've all heard of GM paying out their pensions and companies like that paying out their pensions. So the only people who really have pensions these days are the government, the hospitals, and the teachers. So if you don't work for one of those, or a huge Fortune 500 company may still have a pension, but not many. So what a lot of people have been doing is creating their own lifetime income. And that's what we're doing here. Okay, so let's say I'm getting into retirement. I have this big pot of gold at the end of my work history. How am I going to make that work and last for me? So this is when we get into the funding the living account. Now, you have things most likely, like if you're lucky enough to have Social Security, you may have a pension, you may have other forms of income coming in at your retirement that will help towards that monthly goal. So let's say, for example, you need $4,000 to live on a month. Some of those outside funds will take care of some of this. What I'm interested in, and what you should be interested in this living account, is how much of my investment money do I need to put in that living account to last for 1 to 3 years. And don't think I'm crazy, but in this living account, we put that money in either a money market account or a very conservative bond fund or something like that. And the reason being is if I'm living out of it, I don't want it to be in the market. I don't want it to be affected by that 24% downturn that we just had the beginning of March. So I want it to be there. I want to know that if the market goes down, I can still put gas in my car and food on my table and not have to worry about it. And remember what Jonathan told you, that when we have a downturn in the market, it typically bounces back anywhere from 6 months to 18 months later. So that's why we put 1 to 3 years in this living account, because we all know to buy low and sell high. Well, when the market's low, I don't want to be pulling money out of my intermediate account to put into my living account. I want to wait until the market's high. And that 1 to 3 years gives me that luxury of time to do that. So the intermediate account, we're going to adjust the funds that we're in, and we're going to use some conservative mutual funds. And I have my favorites. You may have yours, but these conservative funds still get, between 7 and 9%. Well, if you're using 4 or 5% of your investment income, if you're only using a percentage of it and you're still gaining more than that, then your fund is still growing. You're outpacing, you're keeping up with inflation, you're adding longevity to your intermediate account. And it will, so that it will be there when you need to move money over, and it just continues to grow there while you're living out of your living account. So what about this long-term account? Well, this long-term account, like I said, is in a variable annuity that has some guarantees. It's a pension-like fund that provides a lifetime income stream for you if you need to turn it on. So let's say my husband needed a nursing home, and you know how expensive healthcare and nursing homes and that kind of thing is. So it's there in case you need to turn on that stream of income to provide for those benefits for a loved one or yourself. And if you don't need it, it's an awesome asset to hand on down to your kids or your other family members or a charity. So that's kind of the 3-fund strategy, and everybody should have some kind of a plan or a strategy of how they're going to spend that. Now, if I've got so much money in my long-term account that I'm never going to use it, maybe that's where that cottage comes out of. Or maybe I take a down payment and instead of paying full price or paying in full for one of those items, I might make payments on it. That way my money can still grow. I'm paying less on interest and my investments are gaining more. So there's a lot of different ways you can do that versus just stripping your retirement account of that money and taking the opportunity of your money to grow out of the market. So here's what I want you to focus on. Hopefully that brought value to you and brought some things, some actionable steps that you can do. But here's what I want you to focus on. I want you to focus on the things that you have control on and not the things that you don't. And these are the kind of things I'm referring to. So the future is Social Security. We just don't know if it's going to be there or not. When I put a plan together for somebody in their 30s or 40s, I don't plan on Social Security. It's just not part of their written plan. Now, if it happens to be there when they retire, that's a bonus, and maybe they can retire early, or they can retire with a higher income. That wouldn't be all that bad, but I don't plan on it. So it's the savings for retirement. It's getting that 2% difference. It's getting your compounding to work for you. And another thing that you don't have any influence over is your employer. Are they going to be in business after this coronavirus is gone, after this stay at home, stay sheltered? A lot of this is going to put a lot of businesses out of business. So are you going to have a job when you go back to? You just don't know. You don't have control over that. Or here's one better yet. What if you are still working and things change, so maybe your manager changed or your supervisor changed, and they just plain don't like you, and somehow they find a way to let you go. You don't have control over that. So one of the best ways that you can combat that ahead of time is to have an extra income stream. Whether that be a second part-time job, whether that be running your own small business on the side, whatever the case may be, T.D. Jakes, a famous pastor, has said that you need multiple streams of income in order to be able to retire. The third one, that brings me right down into the next one, taxes. The government's going to tax what they're going to tax. We don't have a lot of control over that. But you can reduce your taxes, and being not self-employed, but running your own business provides you with a lot of tax benefits and tax deductions that can reduce your taxes. Could be up to 20%. It's different for each person, but that's a possibility. Inflation, we talked about inflation. What you want to do is maximize your contributions into your 401ks and your IRAs, and you want to make sure you're getting great returns on that. The rising cost, well, we could save more, but we've already saved more twice. So how about if we just be a steward of our money and pay attention to where it's going? Now, I teach a lot of people how to build their budgets and get out of debt. And what I find is they usually have about $100 to $200 in their budget that they have no idea where it goes from month to month. Well, I suggest to you that you maybe figure out where that money goes to combat this rising cost, because it's probably going on maybe those expensive coffee drinks, or maybe a trip through McDonald's 2, 3, 4 times too often, or you go to the gas station, you pick up chips and pop. It's amazing where a couple $100 can go. But that's how you can combat the rising costs, is by paying attention to where your money is. And then the risk of a single investment. Diversify. We've showed you several different options on how to diversify. So those are some ways that you can put some of this knowledge to good use. So again, I hope we brought you some value. I hope we gave you something that you can apply and work with. And if you have any questions that aren't on our board already, please feel free to take down our number, Jonathan's number and email address, and mine as well, and just give us a shout out. We'd be happy to answer any questions. All of our services are free, so we can help you pick out those funds if you'd like. If you want just questions answered, we can help you with that as well. So at this point, we do have a couple questions that I did want to answer. One of them was, okay, I'm in my 30s and I can either do college savings or I can do my retirement savings. Which one would you recommend? And I always answer this the same way. And I ask Mr. and Mrs. Client, can you get a loan for your retirement? Have you ever heard of a retirement loan? And they probably look at me funny and they chuckle and laugh and say, well, no. And I said, well, can you get a loan for college, to put your kids through college? And the answer is yes. Now, I'm not an advocate of loans, but I do know at least it's an option for college and it's not for retirement, which gives your retirement priority over your savings money. Now, I have suggested that if you put your money into your retirement and it doubles effectively, you may have enough to help that child pay for his college after he's out of college, so help him pay off those student debts. That would make a whole lot more sense, and you could do that systematically still while your money grows. So there's ways to do it without, if you can't do both, I would opt for the retirement fund, because if you don't, you might be living with that child that you just supported through college. So give that some thought. Now, the second question that I have here is that I have alluded to getting some help with your accounts. So how much does an average financial advisor cost? Well, Consumer Reports actually did a study on that. And what they found out is that the average broker-dealer, to provide a written report of where you're at to where you want to be, and all the comprehensive steps in between in writing, will cost you about $1,100. Now, guys, that's an average. I work mostly with middle-income families, and I can't think of one middle-income family that would pay that to have something in writing for my retirement, for my savings. I wouldn't do that myself. But it is something that you do need. So you need to find an advisor who will do it for free. There are a bunch of us out there that do that for free, and that's what I would recommend. Find somebody that you're comfortable with. Thank you so very much for having Jonathan and I here. We appreciate you all. I hope you all have a great day.